What's going on, everyone? Thanks for tuning into this video. It's going to be an awesome one. Now, a lot of people have been reaching out to me lately. They want to know about the FANG stocks. Facebook, Amazon, Netflix, and Google, all of them having great years, great companies, even better stocks. But some of them can be a little bit expensive. Amazon and Google are over $1,000 a share when shooting this video. And at the same time, managing 4 stocks at once can be a little bit much for people. So they're looking for an ETF alternative to the FANG stocks. Makes total sense. Now, there is not one that's just created for those 4. However, there are a couple options, and we'll go through 5 of them on this video that can give you very similar exposure to the FANG stocks. However, we have found one that is far superior, far superior to the alternatives. Now, I want you to know something before we get in this video. We're doing this on this video. We're going through all these steps for the FANG stocks. However, let me just switch my hands here. However, you can do this for any type of stock. So if you're not interested in owning individual stocks and you're looking to get ETF exposure to those stocks, then you can go through the exact same steps that we're going to go through right here, right now. So buckle up. This is going to be an awesome one. All you guys are going to be experts in this after you finish watching this video. So let me see, clicking buttons. I don't know if you can hear me clicking buttons. I'll see you guys inside the computer. Okay, everyone, we are inside the computer now. The title of this lesson is Who is the Real FANG ETF? Now, this is going to be a really interesting one, and I don't, we're gonna get into it, and we're gonna walk through the actual steps for the FANG ETF and the FANG stocks as they are. However, this is very important, and you can really utilize this for any other stock. So if you want to find an ETF alternative for any stock out there, the same steps that we're going to go through here with the FANG stocks, Facebook, Amazon, Netflix, and Google, you can do yourself very easily for any other stock. So if you're interested in a stock like Kinder Morgan, you want to go through the exact same steps that we have here to find the best ETF for Kinder Morgan. The same thing for a stock like Disney. If you're interested in getting ETF exposure to a stock like Disney, you're going to go through the exact same steps that we're going through today to find the FANG ETF. Now, obviously, FANG stocks, super popular these days. There is no ETF called like FANG for the FANG stocks. So a lot of people have been asking me, hey, I want exposure to Facebook, Amazon, Netflix, and Google. What's the right ETF for me? So we're going to go through those exact same steps for the FANG stocks. But again, pick any stock out there. You can go through the exact same steps. And there's only really 3 or 4 steps to go through to find out which is the right ETF for you. So this is a pretty exciting one, again, because you can use it for all different stocks, all different sectors, all of that jazz. And we're going to show you one today for the FANG stocks. Again, there's a ton of demand for these guys. So let's get into it. Who is the real FANG ETF? And that's me on the right. Hello. So what does FANG stand for? Well, FANG stands for the top 4 technology stocks, or just 4 top technology stocks. The NASDAQ, which is an index comprised of mostly technology and biotech stocks, has done really well in 2017. Well, it does really well every year. And a lot of it, or a lot of the gains, are due to the fact that the stocks like Facebook, Amazon, Netflix, and Google, which make up the FANG stocks, have done really well over the course of the last year. How well have they done? Well, let's take a look. So I'm in the Thinkorswim platform right now by TD Ameritrade. Again, they don't pay me to say this. In most of my videos, we will go into my actual trading platform. They don't pay me to do this or to say this, but I've been using the Thinkorswim platform for the last well over a decade now, and I would never use a different platform. So why are people so interested? Why are people so interested in FANG stocks? Again, here is Facebook. Facebook started the year around 117. It's now at 179. So over the course of the year, Facebook, for example, or by the time we got to this video, today is December 9th, Facebook's gone up about 54% for the year. That's pretty good. Clearly, people want to figure out a way to get some sort of exposure to Facebook. Same thing with Amazon. Amazon this year has gone up about, let's see, 53% as well. A big move in Amazon. So again, Amazon being over $1,000 stock, right now it's at 1162. People would love to find some sort of ETF exposure to something like Amazon as well. Amazon is up 50%, just like Facebook was. Netflix is the third stock in the FANG stocks. Netflix is up about 50% as well. So again, people would love, and it's $188 a share, so people would love exposure to Netflix as well. And finally, Google was up this year about 30%. So obviously people would love to figure out a way to have some sort of ETF exposure to Google as well. So all these 4 technology stocks make up FANG, F-A-N-G, Facebook, Amazon, Netflix, and Google. And clearly there's a lot of demand for these stocks because, again, Facebook, Amazon, Netflix, all up a little bit over 50% for 2017. Google up about 30%. Still, all 4 of them outperforming the overall market. All of them things that people interact with every single day, which makes it really, really cool. Facebook is something that people go online and check their social media and see what everyone else in the world is up to. Amazon, one-click buying pretty much anything now. Netflix, when people come home for the day, they turn on their Netflix and they watch House of Cards or Orange is the New Black or whatever Netflix series they like. And then Google, anything someone is searching for or looking to find out any information online, people go through Google. So it's kind of a double factor. You have stocks that do really, really well, and you have companies that are integrated in individuals' lives on a day-to-day. This creates a ton of demand for exposure to those type of stocks. Now, what's interesting about these stocks is they typically move together. So if Facebook is up on a day, it's likely that Amazon, Netflix, and Google are up on the same day as well. Now, we talk here about FANG stocks move with an 80+% correlation to one another. We'll get into a little bit more of what correlation is later on in this video, but the way to think of this is 100% correlation means any stocks move tick for tick, price for price together. So if Facebook were to be up 1%, if we saw 100% correlation between Facebook, Amazon, Netflix, and Google, if Facebook were up 1%, Amazon, Netflix, and Google would all be up exactly 1% in the same day. So they move with the exact same price movements about 80% of the time. That's the way to think about it. So not only are they all up a lot this year, not only are they all integrated in normal daily human life, but also at the same time they move very much together. So these are the reasons why there's a little bit of a demand for ETF. So why an ETF? Well, an ETF, and again, not just talking about FANGs right here, Facebook, Amazon, Netflix, or Google, just talking about ETFs in general. There's a lot of information on the internet about ETFs, and most of it is kind of useless. The way to think about an ETF is it's called an exchange-traded fund, and it's just a basket of stocks that could be traded as a single stock or asset. That's all it is, really. So ETFs they are managed by people, and those managers of the ETFs can pull can own baskets of all different stocks, whichever stocks they want, and they could present them as an ETF. So you can get exposure to all of the stocks within an ETF at the same time. That's really what it is. And it allows investors to have exposure to multiple stocks, potentially multiple stocks in multiple different sectors, multiple different countries, multiple different currencies at the exact same time. And what it does in a lot of them, the goal of them is to have a diversified ETF. So you could have one stock that's industrial, one stock that's healthcare, one stock that's technology. You can bundle them all together and you will have created a diversified ETF, if you will. And it all is able to be traded under one symbol, one stock. And the way ETF gets its price, it's weighted proportionally based on the holdings of the individual stocks in the ETF. So let's say there are 10 shares of Amazon and 1 share of Facebook. Well, obviously that ETF's price is going to be more is going to be impacted greater by a price movement in Amazon than it is in Facebook, just by the sheer size of Amazon compared to Facebook. Amazon right now is, let's call it $1,000 a share. 10 of those would be $10,000 in the ETF. But if Facebook only had one share, that's only $180, right? So it's such a small fraction. It's about 1.8% of the entire ETF. So obviously it would become more, the ETF its price will move a lot more if Amazon moves. But don't worry about that. That's not really a thing. So then why a FANG ETF? Now we already kind of touched on this a little bit, but investors want exposure. Facebook, a top stock, up 50% this year, as well as pretty much every family member in every family is utilizing Facebook on a given day. Amazon, also up 50% this year. And again, very integrated in normal daily life. Many purchases that a normal family or an individual has on a given year are through Amazon. Netflix, very integrated in daily life. At the same time, families share Netflix accounts where they're watching their favorite shows, their favorite documentaries. And at the same time, Google, very integrated in daily life. It's the home screen of the Chrome browser, as well as utilizing any search on any phone, whether it be the Safari browser or the Chrome browser on the phone, automatically is searching on Google. So again, not only that, Google up 30% so this year. So why not? Why not have exposure to all four of those? I know about them every single day. I use them every single day. And at the same time, they're up a ton. But a little bit of a setback is, number one, it might be a little bit time consuming for people, or they might feel like it's a little bit time consuming to maintain 4 different positions. As well as you guys saw, some of these stocks, Amazon and Google, are over 1,000. Netflix and Facebook are almost $200 a share. They can be expensive to purchase in equal weight between all of them. If you want to buy, you have to buy 5 or 6 shares of Facebook to get 1 share of Amazon type deal. So again, the two reasons additionally are, again, it becomes a little bit time consuming to own all 4 stocks, to manage all 4 stocks, as well as they can become kind of expensive, right? So because of these reasons, investors look for an ETF, right? They look for this basket of stocks that give them similar price movements for the FANGs at a cheaper price, with the ability to get in and out whenever they want in the shortest amount of time. So again, by this point, we haven't talked about charts. We haven't talked about indicators. We haven't talked about balance sheets. We haven't talked about, Fibonacci. We haven't talked about Elliott wave. We haven't talked about earnings. We haven't talked about any of that stuff. We're just very much thinking logically at this point. First, Facebook, Amazon, Netflix, and Google are all up a lot this year, and all are typically good companies. Good companies that are integrated in daily lives of people. So this makes investors interested in owning these stocks. Some of the drawbacks, however, are, number one, it can become difficult for people to maintain 4 separate positions, like owning Facebook, Amazon, Netflix, and Google outright individually by themselves. And at times, for some people, depending on how much money you have or how much capital that you have remaining in your investment accounts, it can become quite expensive to own all 4 separately. Remember, Amazon and Google are over $1,000 a share, and you cannot own fractions of a share. Now, because of these reasons, investors look for an ETF. Now, this is where it becomes pure logic. This is where we don't talk about charts, indicators, Fibonacci, balance sheets, what other investors are doing. This is where it becomes pure logic and is pure simplicity and pure common sense. Because it maybe is annoying to own 4 stocks at once that very much do similar things, because they can become quite expensive. We're just looking for 3 things when we're looking for an ETF to substitute owning the 4 expensive stocks all at once. We're looking just for 3 things. The first thing we're looking for is we want an ETF that, again, is just a basket of stocks. We want an ETF that gives us similar price movements to the FANGs. Totally makes sense. The second thing we're looking for is something that is cheaper priced. The last thing we're looking for is the ability to get in and out whenever we want in the shortest amount of time. So if we do not want to own Facebook, Amazon, Netflix, and Google by themselves for either the reason that they're expensive or owning them is or owning all four at once is maybe a little bit too time consuming, we want to find an ETF that gives us similar price movements for a cheaper price and where we can get in and out whenever we want. Now that in itself is very, very logical. Very, very logical. It has nothing to do with balance sheets or books or any of that. It just makes total sense. So let's go through all of those right now to figure out which is the best FANG ETF for us. Which ETF out there can get us the similar price movements to Facebook, Amazon, Netflix, and Google for a cheaper price than all four of them with the ability to get in and out whenever we want. That's all we're looking for. Very, very simple. Again, that's all we're looking for. The first thing we're looking for is an ETF that gives us similar price movements to the FANG stocks. Now, the way we're going to go ahead and determine this, and we kind of touched about this later, is something called correlation. Right? So the way to determine if an ETF gives us similar price movements to the four stocks will be by determining the correlation between the ETF and the four FANG stocks. And what correlation is, it's just a comparison of price movements. It has nothing to do with sectors. It has nothing to do with indexes. Two technology companies might not have similar price movement. Although they're technology companies, they might not be seen as diversified, but they could have completely different price movements, and price movement does not lie. So when we talk about correlation, all we care about is how do their price movements compare to one another? Not what sectors there are, not what industries they are, not the location of the company, let's say in the United States versus international. All we care about is what do the price movements look like? The second thing, for a cheaper price. Again, as of writing this presentation, as of shooting this video, the cost of buying 10 shares of each FANG stock are the following. First, 10 shares of Facebook, $1,714. Now, for some people, that's a little bit pricey. 10 shares of Amazon, a little bit over $11,000, right? That becomes a little bit more pricey for more people. 10 shares of Netflix, $1,840. Again, just for 10 shares, could be a little bit pricey. And then for Google, just for 10 shares, you got to fork up a little bit over $10,000. Now, if you wanted to own 10 shares of each of the FANG stocks, and again, that would make total sense. They're all up between 30 and 50% for this year. They're all phenomenal companies with excellent executive teams. You're going to have to fork up over 25 grand. That becomes a little bit pricey, as well as, again, to manage four stocks. They have earnings on different days. It could be a little bit too much for some people, which is totally okay. So clearly there's a need to get similar price movement, again, correlation, at a lower price. And finally, once we have an ETF that gives us similar price movement for a lower price, we want to be able to get in and out whenever we would like in the shortest amount of time. So again, compared to managing four positions, we just want one position with the fairest and most efficient markets. Now, in order to find this, in order to find which ETF gives us that, right? In order to find out which ETF that gives us a cheaper way to have similar price movements to the FANG stocks, which will allow us to get in and out whenever we want, we have to find an ETF with sufficient amounts of participation. Now, let me repeat that. I might have kind of fumbled that a little bit. We want to find, after we find the ETF that gives us the same type of price movement for the lowest price, we want to be able to get in and out whenever we want. We don't want to have to wait till the end of the day or the next day to get out if we want to get our money, if we want to book our profits. We want to be able to get out whenever we want because we want to find an efficient market that has the most amount of participation. Now, the more participation in a stock, or in this case an ETF, the better price we're going to get at the quickest amount of time. If more people are participating or competing for shares of an ETF, that is a very, very good thing for an individual investor. It will allow that investor, again, to get in and out whenever they want in the shortest amount of time. Now, don't worry if you don't understand what participation or competition looks like in the stock market. We're going to show you here. So don't worry. Now, again, we want to find an ETF that gives us the same price movement as Facebook, Amazon, Netflix, and Google all together for a cheaper price with the most amount of participation, so that when we want to get out, we can get out instantly at the best price imaginable. Now, our contenders for a FANG ETF were found by a simple Google search, just typing in FANG ETF in Google. We have 5 contenders. The first contender, First Trust Dow Jones Internet, symbol FDN. The second contender, PowerShares Nasdaq Internet, symbol PNQI. And I'm sure as I'm going through these, some of you who are watching this have seen these stocks before, have heard about these stocks before, have seen these symbols. So this isn't nothing new to a lot of people. The third contender, PowerShares QQQ, symbol QQQ. The fourth contender, First Trust ISE Cloud Computing, symbol SKYY. And the fourth contender, Technology Sector Select Spider Fund, symbol XLK. So based off of a simple Google search, looking at a handful of articles and videos, it looks like these are the 5 most recommended ETFs for people who want exposure to the FANG stocks. Great. Remember, we're looking for an ETF that gives us the same price movement for a cheaper price with the most participation and competition, so that we know when we want to get out, we can get out instantly for the best price. Makes total sense. Again, guys, we haven't looked at any charts. We haven't looked at any indicators. We haven't looked at Fibonacci, any of that stuff, balance sheets. We haven't looked at any of that. We're just using basic common sense here. So let's go through and figure out which is the right ETF and which is the FANG ETF. Let's go through that. The first thing, an ETF that gives us similar price movements. So again, we talked about this previously, but we're looking for an ETF that gives us similar price movements to Facebook, Amazon, Netflix, and Google. So what I've done here is I created a watch list. I created a watch list of the 5 potential FANG ETFs. And what we're going to do is we're going to figure out their correlation to Facebook, Amazon, Netflix, and Google. And the way we're going to do that is we're going to use the Thinkorswim platform to do it for us. So what's going to happen here is we're going to input all 4 of these stocks, Facebook, Amazon, Netflix, and Google. And what it's going to do is it's going to compare the price movements of those FANG stocks to these ETFs over the course of the last year. So on a day where, let's say, FDN is up 1% and Facebook is up 1%, you will see a 100 correlation or 1.00 correlation between the two. That is the highest level of correlation. That is extremely, extremely correlated. Everything over an 80% correlation we consider highly correlated, and it will allow us to have high confidence that one of these ETFs is going to have very high correlated price movements and have very similar price movements to our stocks. So we're looking for anything over 80% to say we are finding an ETF with similar price movements to these stocks. So what I'm going to do is I'm going to click this little gadget over here. I'm going to click on correlation. We're going to set the length to 200 days. There are 200 trading days of a year, give or take, and we're going to set it to Facebook. So now it's doing its little calculation, and we see that all of these ETFs have very high correlation to Facebook. So this means they move in terms of price similarity to Facebook all greater than 90%. So all of these ETFs are very highly correlated and have similar price movements to Facebook. Let's go on to Amazon. I'm going over here, I'm typing in Amazon. Amazon doing a little calculation over the last year. And we see, now, not as highly correlated Facebook, but again, clearly all of the options are greater than 80%. So all of these ETFs not only have the same price movements as Facebook, but they also have the same price movements as Amazon. Now let's check out Netflix. Netflix, doing its little calculation, and we see positive results, 90th percentile in all of these ETFs. So right now, all 5 of these ETFs have very similar price movements to Facebook, Amazon, and Netflix. Let's see what Google looks like. Google, Googl, and doing its little calculation. So we have winner across the board. So FDN, PNQI, QQQ, SKYY, and XLK all have very high correlation to Facebook, Amazon, Netflix, and Google, which means, remember, the first thing we're looking for is we want an ETF that gives us similar price movements to Facebook, Amazon, Netflix, and Google, the FANG stocks. All 5 of these do that very, very nicely. So they all pass. All contenders will move on to the next round of our competition. There's going to be 3 rounds, as their price movements are highly correlated to the price movements of all 4 FANG stocks. So that's excellent. All of them move on to the next round. The second thing we're looking for, again, we have found 5 ETFs that give us similar price movements to the FANG stocks. Now we're looking for ones that for a cheaper price. So if you remember, it's expensive to own 10 shares, just 10 shares of all 4 FANG stocks at the same time, as well as it becomes a little tedious to manage 4 different stocks at the same time, especially if they're doing almost the exact same thing. So 10 shares of Facebook, Amazon, Netflix, and Google is over $25,000. So here's the amount we need to buy 10 shares of each ETF in our competition, which, remember, have already passed step number 1, which is that have similar price movements to the FANG stocks. First Trust Dow Jones Internet, it's about $1,000 to buy 10 shares, much cheaper. PowerShares Nasdaq Internet, it's about $1,000 to buy 10 shares of this ETF. PowerShares QQQ, about $1,500 to own 10 shares of this ETF. First Trust ISE Cloud Computing, SKYY, about $450, only $450 to buy 10 shares of this ETF, which again gives you very similar price movement to the FANG stocks. And finally, the Technology Sector Select Spider Fund XLK, about $620 to buy just 10 shares. So as you can see, all of these are clearly cheaper options. So the first thing we had to look for was which ETFs gives us similar price movements. All of them did that. The second thing we were looking for is which ETF gives us a cheaper alternative with these price movements, and all of them pass the test. Every single option is less than 6% of the total cost of 10 shares of each FANG stock, and something like SKYY is less than 2%. So obviously these are all not only highly correlated in terms of the same price movements as Facebook, Amazon, Netflix, and Google, but they're all much cheaper options. The third part of figuring out which ETF is the right ETF for us, and specifically which is the FANG ETF, is getting in and out in the shortest amount of time. So here we're looking for the most participation. The more participation there is in a stock, the more competition there is for shares or options contracts. And the more competition there is, we're able to get in and out at a quicker amount of time at the best price. So this is kind of going to be the deal breaker here, since all 5 of these ETFs have passed our first 2 kind of tests in this quiz. So there's 3 things we're going to look for to determine if we will be able to get in and out whenever we want in the shortest amount of time. There's 3 things that we're going to look for to see who has the most participation, the most competition, because the difference between this is a lot of dollars on your bottom line, and we'll show you exactly why here in a second. So the first thing we look for is the total stock volume. So the higher, the better. Any stock or ETF that doesn't trade a few million shares a day, that is not a lot of participation. And if there's one of these ETFs does not reach that $1 million mark on a given day, it's going to be taken off our list, because that's going to create a very wide bid and ask spread, right? So the second thing we look for, and even though the answer number 1 is pretty telling for number 2, we look for a tiny bid ask spread. The smaller the spread, the better. The bid is the lowest amount that someone is willing to buy stock for. The ask is the highest amount someone is willing to sell for. So if we go over to the Analyze tab here and let's type in something like Facebook, and no, this is after hours, so this is kind of bad. So what I'm going to go ahead and do is this. We're going to go on demand, and we're going to go to August 10th, sure. So what you could do is you could use this on demand tool that will allow you to go back in time and look at prices as they were going on a given day. So what I'm going to do here is I'm going to try to pull up a bid-ask spread during the day. So this might take a little bit, but this will show you what the bid and ask spread on something like SPY, which is the S&P 500 index ETF, would actually look like on a given day. Remember, the bid is the lowest price that someone is willing to buy shares for or buy for, and the ask is the lowest price someone is willing to sell for. Now, if the bid and the ask spread are very wide, more than a few pennies wide, that means that there's not a lot of confidence, there's not a lot of participation, there's not a lot of demand, there's not a lot of competition for those shares. Right now we're looking at SPY, which is a $260 stock. It is the index ETF for the S&P 500. It's a $260 stock, and as you're watching, the bid and the ask spread are a penny wide, sometimes 2 pennies wide. What this tells you is there is a ton of participation, but not only that, there's a ton of competition for these shares, right? There's a ton of competition for these shares. But something like Priceline, for example, and this might take a second to load up, something like Priceline, which is I think it's over $1,000 a share, that bid-ask spread is going to be a lot larger because there's a lot less competition for these shares. Now, with that means you're going to have to take a loss to enter the position. When we look at SPY and when it was only 1 penny wide, you don't have to take a loss to enter the position. If you want to buy stock, you'll buy stock at whatever the ask is, and you won't be a loser at all when you enter the position. When you look at something like Priceline in front of us, that's a $2 wide, almost $3 wide spread between the bid and the ask. So if you want to buy shares, you have to buy them at the ask, which is typically far above the last price. In this case, it's 20 cents above the price. So you're going to have to give up 20 cents a share in this example, or in this case, you're going to have to give up even more. Now you're going to have to give up $2. Now you're giving up $2 a share, and that becomes very, very expensive over time. That is why it's very important to, number one, have total stock volume very, very high. That will shrink the bid-ask spread. And finally, after we see total stock volume over 1 million shares a day, and after we see the stock bid-ask spread less than 7 cents a share, we want total options volume in the thousands for a day. Options are contracts. They're agreements to buy or sell 100 shares of stock on a given day at a predetermined price. And options are utilized by institutions, hedge funds, and money managers. If we see options volume, then we know that there are institutions, hedge funds, and money managers who are hedging their stock positions via options. If we were to go ahead and find a stock that has maybe a couple dozen, or let's say a few hundred options contracts traded on a given day, that is a clear sign to us that there are no big players in that stock. Thus, we're not going to be able to get in and out at the right price at the right time for what we want to get in and out on. So again, those are the 3 things we're going to look for to determine which ETF can get us in and out in the shortest amount of time at the best price. So the first thing we're looking for, total stock volume. Again, anything under $1 million, that is really no good. That means the bid-ask spread is going to be too wide, and we don't want to have to take a loss to enter the position. So, total stock volume yesterday. First Trust Dow Jones Internet, 632,000 shares traded. PowerShares Nasdaq Internet, PNQI, 72,000 shares traded on a day. PowerShares QQQ, a little bit over 51 million shares traded. First Trust ISC Cloud Computing, about 118,000 shares traded. And finally, Technology Sector Select Spider Fund XLK, almost 17 million shares. So again, we want to see total stock volume over 1 million shares, which would mean goodbye FDN, goodbye PNQ, and goodbye SKYY. Just off the bat. So although those three that we just removed from our competition had very similar price movements to the FANG stocks for a cheaper price, it doesn't matter because we're not going to be able to trade or invest in those ETFs and get a fair price. So it's completely out, gone, goodbye, never to be thought of ever again. The second thing we're going to look for is a stock bid-ask spread. Now remember, this is critical because a stock bid-ask spread that's over 7 cents wide means we will have to take a substantial loss just to enter the position. And we're not interested in doing something like that because that doesn't put the odds in our favor. That's one of the very few things we can control in the stock market. So PowerShares QQQ, penny wide. XLK, 2 cents wide. Both of these clearly pass our test. Both of these clearly pass our test because we will be able to get in at fair market value in a very short amount of time. Total options volume, which is kind of the third thing we were looking at here. We want to see it in the thousands. If we see it in the thousands, we have good confidence that institutions are hedging their stock positions via options. PowerShares QQQ, about 978 options contracts traded on a given day. XLK, about 21,000. So while QQQ is much greater, XLK still has the right type of options volume that we're interested in. So now, both of these have kind of passed our tests, but we have to figure out which is the best because we're only looking for one ETF to be our FANG ETF. So again, where have we gotten to at this point? QQQ, XLK both give us similar price movements to Facebook, Amazon, Netflix, and Google for a cheaper price. So we want to figure out which is the best for us based off of who has the most participation and competition. The ETF that gives us that will allow us to get in and out for the cheapest amount of price at any size we want, whenever we want. And looking at this, QQQ just happens to have a lot more competition, a lot more participation. Right, the total stock volume is obviously about 3 times larger in QQQ than XLK, and the total notional value is about 8 times larger. The total notional value of shares traded at QQQ on a given day is about $8 billion. The bid-ask spread is a penny smaller, which over tens of thousands of shares traded in a day will add up. And the total notional value of options contracts traded on a given day is something like, I don't even know, so much bigger. Let's see, we'll do that by times 5, times 15. So about 105 times larger on a given day is the total options notional value of QQQ when compared to XLK. So while XLK is an okay ETF to get exposure to FANG stocks, QQQ is far superior. QQQ moves with high correlation to Facebook, Amazon, Netflix, and Google. QQQ is a cheaper alternative, only about $150 a share. However, it is a king when it comes to being able to get in and out at the shortest amount of time. It's an absolute king because it trades crazy notional value. Looking at this information, it means big institutions are trading in and out of QQQ all day, every single day, which means if you want to get in and out, you can get out whenever you want at fair market value. So guys, to wrap it up, QQQ is the FANG ETF. Now remember, we did this for FANG stocks, but you can go ahead and do this for any stock out there if you're looking for an ETF alternative for the stock. So for 95% of the price movement for Facebook, Amazon, Netflix, and Google, you get an ETF that is cheaper to buy and can be bought and sold whenever you want at fair market value. So ultimately, let's wrap it up. If you want to trade the FANG stocks, Facebook, Amazon, Netflix, and Google, but don't have enough money to trade all of them, or don't want to worry about 4 different positions, we have found the perfect ETF for you if you want to get exposure to the FANG stocks. It's QQQ. It gives you 95% of the price movements for a cheaper price, and you can get in and out whenever you want. So, if you want exposure to all 4 FANG stocks and you want to do it all at once in an ETF, buy or sell QQQ. Thanks for tuning in, guys.